What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 3rd of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to ask a big question on the minds of a lot of people in the crypto space, and that is, how low can Bitcoin really go within this bear market before we kick off the next major bull run? I know a lot of people are hoping that we've already set in a bottom at current levels, and many people are eager to start dollar cost averaging and buying the dip, as history has taught us to do this. But the big problem that I find when it comes to investing for a lot of people is they start to think just how much money they can make. They start to think that things are guaranteed, and they don't ask the big question that every professional trader and investor asks, which is, how much can I lose? That's a very important question we're going to dive into as we dive into 3 potential scenarios for where Bitcoin could go throughout the future. If you like this video, consider dropping a like, and let's go ahead and kick off the conversation, guys. It's going to be a good one. So I want to go ahead and first just talk about the current scenarios that we laid out here on the chart. We've already given some key price points here around the 80% range and 85% as well, in the sense from a top to bottom decline. That's the kind of terms we're going to be talking about here, not so much what we have left to decline here. We will talk about that a little bit, but essentially we want to give you guys those top to bottom estimates. And we're going to be taking a look at history, but also trying to understand how things may play out if we're experiencing something we haven't experienced before. Crypto, again, I want to make this very clear, guys, is still an early market. Crypto's been around, in the sense of its trading and price action for the last 10 to 12 years, roughly speaking. And even back then, it was relatively illiquid and just starting out as an asset. We've really only had liquid tradable markets for crypto just over the last kind of 5 to 7 years, where serious liquidity and volume can start to trade it. So we need to understand here that Bitcoin is still very much in its infancy as an asset class. And that's also very exciting in the long term, and why, again, I want to make it very clear, guys, I'm incredibly optimistic about crypto long term. I think that there will be a great dip buying opportunity, but we got to be smart about where that low could be. So let's just go ahead and dive into it here. Now, I want to go ahead and pull up a really important chart here. The first lightweight scenario here that we should consider is the fact that Bitcoin will likely just play out another bear market, right? Another 80% correction that we tend to find every couple of years. And that's what many people are still, at least for those who are currently invested or who are maybe in cash and looking to buy the dip. Most people are thinking in this mindset. And of course, going off of history, at least from what we have on the chart, it makes total sense why people would feel this way, why people would be betting that we're going to have a typical bear market correction. Now, so far, this alone already signals why I've been calling here on this channel for further price down, even if you are in this more kind of optimistic, more bullish case scenario. And I'll explain why that is later on as we take a look at the other ones. If you are in this camp that we are going to have a typical crypto bear market correction, even though as time progresses with each bear market, we see weaker and weaker bear markets, I want to signify here that we're likely not going to drop all the way from an 84% correction, which we had in the last bear market in 2018, all the way to only a 74% correction over 7 months. This is very important to notice here. Now, outside of excluding the 2011 bear market, which again, we need to understand here, we're looking at the logarithmic chart, which again is just so far and distant here. When we take a look at more of the mature bear markets, when we had liquid exchanges, we can see that the corrections were more severe here in the 80% range, not too far off from one another, and they took about a year to play out here. Now, if people are saying that the bottom we set in June was the low here, we're talking about 74% correction in price, and on top of that, only 7 months of decline. Some people might argue again that we actually set in the top back here. It's been 14 months. And while I would say there's a fair argument to be made for that, altcoin valuations did very well in this secondary run-up, and we hit into a new all-time high at around a $3 trillion market cap. So I think that the November highs make sense because that's not only where crypto topped out, but also equities. So at a minimum, if you are in that camp, if you're betting on the best case scenario, you should at a minimum be looking for an 80% decline. Now, interestingly enough here, this takes us much lower here towards around 13,000. And this is one of the first important tips that I want to share with you guys that you should always keep in mind here when you're trying to preserve capital. In an environment like we're in right now, with high inflation, with the broader asset market declining, it's important not to get caught up in every single fire sale, every single new low, because a couple percentage points, when we're measuring from top to bottom, when we go from a 70% correction down to an 80% correction, the difference is not negligible. It's massive. You will be able to buy a lot more crypto if you can wait around for those dips, or even worse off in this case, if you enter in too early, you could be facing huge losses. Just to put it in perspective here, we'll go ahead and dive into the chart, right? Let's take a look here. If we were to kind of zoom in on a shorter term time frame, let's go to the weekly. And let's say, for example, that you had bought the absolute low here, or at least the low here in June. Now, you were up on your money here, right? You're up 38, 39%. It's looking great on paper, but you're holding it for the long term. You're holding it for the next bull market, right? That's the key goal here. We're keeping it simple. We want to buy the dips, buy the bear markets, sell at the bull markets, or just hold long term. Well, as we saw here, as we talked about in the channel, this was a relief rally, very typical in bear markets. It rolled over here, and now many people are just slightly in the green who might have picked the absolute low here, right? But what happens if we go all the way down to these levels? We are seeing a near 26 to 27% correction from those absolute lows. That's a pretty steady amount of red. And as much as many people would say, I'm just going to buy it, I'm just going to ride the wave into the next bull market, a lot of people, whether they like to admit it or not, would probably emotionally trade. They'd probably sell their position, especially if you're dabbling in messy tools like leverage, which we speak out vehemently against here on the channel. You won't see any Bybit referral link down in my description. As you all know, those are the kind of things that can get you caught up. There are many professional traders, Stanley Druckenmiller, even people who are controversial like George Soros, who have admitted that in their own trading journeys, some of the biggest mistakes they made were exposing themselves to too much volatility, too much risk in periods of uncertainty. That is the definition of volatility, is how volatility in the chop of the market, the unpredictability of where things could go, and just how bad things can get, can really knock out a lot of people, even if you're not using leverage in this case, because of the emotions and price. People really misunderestimate just how much of a move here a couple percentage points can mean on a top to bottom decline. Now, we've taken a look here at Bitcoin, but on top of that as well, I want to go ahead and dive into the portion on equities here. Now, the equities conversation here is going to bring us in to our potential second outcome here. And this is the one that we've at least at a minimum been championing here on the channel. It's not that I'm looking forward to it as much as it will provide a great dip buying opportunity. It will mean a lot of pain in the economy, but it's a realistic outtake. At a minimum, the most realistic outlook we can see with the current macro environment and the uncertainty. Now, what this scenario is calling for here is a potential 50% or more decline across the board in equities, something that is very important to note that Bitcoin has not experienced yet. I really want to drive this home, guys, because if you're exposed in Bitcoin, you're exposed in Ethereum, or the other 15,000 altcoins that supposedly have some kind of dollar value to them, if you're exposed to these, a lot of that wealth, which has probably already diminished since the $3 trillion market cap highs back in November last year, could go even lower. It could go down another 25, 50, 75%. Trust me on this, it's happened before. We've seen this in events like the 2008 recession. We've seen this in the dot-com bubble. We've seen this in a multitude of typical bear market corrections in equities. And over the last decade, since crypto's trading, we can see here, we're taking a look just at the Dow Jones. I mean, not to mention really how well the NASDAQ and the S&P 500 has performed, but we'll come back to why we're looking at this in a moment. We can see here that crypto really started trading on Bitstamp, one of the first exchanges here back between 2010 and 2011. It's been only alive during a secular bull run here, where year by year, we either remain relatively flat or are making serious upper single digit to double digit gains year over year. And now we have had a 20% annual decline. And it looks like we're very much going to be coming in on this red close. Something, again, just looking back at the chart here, unless something real magical happens by the winter, is going to be the first major double-digit red candle since 2008. So this is no laughing matter, guys. Again, I know there are a lot of people who are very confident here that this is just a great dip buying opportunity, but what we've seen so far may just be the beginning for Bitcoin, especially considering the direct correlation between these assets over the past year, year and a half in the sense of their price performance, okay? So we're just trying to be realistic here. Now, if we were to see a correction in equities, this kind of 40-50% decline, where could we really land? And does this really seem justified when we take a look at the long-term charts? Well, if you guys haven't noticed yet, we're taking a look at the Dow Jones Industrial Average here, and this is the 12-month chart, meaning that each of these candles represents an entire year. So we are going back as far as possible. This is one of the longest viewpoints we have on equity markets, back to 1896. I would assume that practically none of you watching this channel were born as far back as that. I sure know I wasn't, and I don't know anyone in my personal network born that far. So we've got a lot of data to work with here on the equity markets. Now, when we take a look back, what I find here, looking at the chart, is that there are really three bands here. There is the exuberance band. This is where, again, things get overextended. It's what led us into the roaring 20s, where equities were going up to ridiculous valuations. People could use, this is really interesting stuff here. This is the way how bubbles are built, is through excess credit. And people could utilize their shares that they already owned, the equity portfolios they had, to borrow money. And that allowed them to go out and buy more stocks and speculate even more, make more paper returns, which led to a brutal correction down into the fearful territory, right? The overt fear and uncertainty band here at the bottom, or the low band, I would say, as well as this being the high band. And then we have what I would call kind of the neutral band here, the midpoint of the overall long-term uptrend. So as you all can see, I'm a long-term optimist here. I think the future is going to keep going up here. And this is, again, just the Dow Jones. The S&P 500 and the NASDAQ did much better over this the last few decades here. So it's important to note that I'm just using this as a benchmark, though, to talk about sentiment. Because if the Dow Jones is trending lower, it is likely going to mean that the S&P 500, the NASDAQ, and crypto, along with the broader basket of assets, are going to be getting hit quite hard. So let's go ahead and dive into this topic here. What can we look for? The first thing here, again, as we talked about, is the second scenario, and that would be a 50% correction down here to the midpoint line, as we saw back here in 2008. This would be relatively expected, especially if we go into Q1 of 2023, giving us, in this case, over a year, year and a half since the previous bull market highs. That would be a very interesting place where we could start to maybe find some value. If not anything, we could at least find a good buying opportunity to make a short-term trade. But if this were to go much lower, as we'll talk about later, that's where we have to be concerned. Now, one really cool metric you can utilize on the 12-month chart is the 21 moving average. As you all can see here, usually when prices dip below the 21-year moving average, essentially, this is usually a great dip buying opportunity. It helped us to find the lows in 2009. It also showed us as well when the decade of inflation here into the 70s, again, was starting to find new support. It wasn't visiting lower here. Every opportunity below this was a great dip buying opportunity for the next secular bull run going into the 80s and 90s, right? So we can start to look for some serious value here. And if equities are going to be declining 50%, which again, crypto has never lived through before, you can probably bet at a minimum here, as we go here to our chart on crypto, that we're at a minimum going to be coming down to around $10,000, this 85% mark here, right? And this could be, again, not only an opportunity where as equities are declining severely, crypto declines, but maybe it starts to deviate here. And maybe it starts to do what gold did back during the last inflationary period, when people lose trust in central banks, when people lose trust in the financial system, and they look for something that isn't correlated to a corporation or a government or a central bank, right? So that's something that I think is very realistic to see here, is around this $10,000 mark. But I want to go ahead and talk about the worst case scenario here. as we take a look here at the charts. And this is going to lead us into diving into some really interesting ratios. So I'll explain this. You guys have probably seen me talk about this or have mention it. And that is a ratio between a major stock index, like the S&P 500, and dividing it by the money supply, the M2 money supply. Now, when we take a look at this chart here, I think this gives us a really interesting clue as to where things might go. If we understand the real value of equities is not just determined by its price or the performance of an index, but rather by a division of the money supply, right? If we, for example, just 10x the money supply tomorrow, equities will probably go straight up, kind of like they did during COVID. And everyone thought they were getting rich, but in reality, equities had dropped severely in real terms because of the expansion of the money supply. And in fact, we have never really gotten back up to the euphoric equity highs in the S&P 500 and the NASDAQ or the Dow Jones since as far back as 1999, at the turn of the millennium here. Because since then, the only thing that has really propelled or kept stocks up is the amount of money in the system that has been injected through quantitative easing, through record generational low interest rates that are all now starting to revert. And without those buy-side pressures, we are likely going to see equities decline much further from where we are right now. Now, you can see here from kind of top to bottom, if we were to, for example, set a higher low here on this indicator, that's why we've got this line of support, we are looking for that. That could be our 50% decline across the board, roughly speaking, in equities. Considering that we were looking at, in the chart here for the Dow Jones, around a 50% correction, the S&P 500 may see a 56% correction. The metrics aren't always going to be the same for the indices here. And the NASDAQ might get hit all the way down to 60%. But I want to go ahead and talk about the big question mark. And this is that third scenario here. What if we see a similar correction to that of the collapse after the Roaring 20s into the Great Depression? What if we see something akin across the entire stock market similar to the dot-com bubble, right? And this is a big question here that we need to ask ourselves, because that could lead us back down into more generational support like what we saw back here in the 70s for equity market valuations, considering the debasement of the money supply. And I think this is an important question to ask ourselves. Again, it is unlikely. I'm just going to go ahead and say it. It's very far out here. But what would that look like for crypto if we saw that kind of correction? I can tell you guys, there is a very good chance, and I know it sounds crazy, but if this were to happen, we would easily see Bitcoin come down here towards a very painful level of around 90%, down to around, probably, considering that this would take some time, somewhere around, I'll go ahead and put it here as our third option, around here, around 90% correction here. This could spell some serious pain here, a major flush out on the market, and lead us down to one of the baselines of support that's been being built up since back in 2017. And then give us the foundation for the next major bull run. Again, it's like a 10% likelihood. That would be if the world really just continues to perpetually deleverage, that we don't turn back the money printer on, right? I think that we are likely going to be in the middle scenario, scenario 2. I think that that is at a minimum where we can start to severely dollar cost average, essentially here from around 14K down to $10,000. I think that that is going to be a significant point of interest. But what if it does go lower? Will you be willing to continue dollar cost averaging for the next 2 or 3 years into those price ranges? Will you have the economic fortitude? And this isn't an insult to anyone. Even I'm thinking about, everyone should be thinking about, if they want to be financially literate and they want to be prepared for the future. What if you lose your job? What if your income doesn't rise with inflation? What if the cost of goods and services keep going up? If the Fed can't get a grip on inflation? What if there's some domino that gets set off during the Fed's tightening and puts us in a similar scenario to 2008? I don't mean to be negative here. I'm a pragmatic optimist usually. I think about the long term here. I know that the chart goes up and to the right long term, and I understand the power of dollar cost averaging and buying the dip. But sometimes you got to know when you're in a secular bull market where 15 to 30% declines are screaming buy opportunities, when the general trend is optimistic. And you got to know when we are in a bear market, when we are in a real proper recession and or potential depression. And when that happens, I don't even want to begin to think about what that's going to mean for crypto. And bear in mind, 15,000 altcoins out there that have a lot of value it's not real. And people are going to realize real quick that there are a lot of people without a chair to sit down in the game of musical chairs. Crypto was really never worth $3 trillion at that point. No market that reaches those euphoric highs was ever really worth that much. Even if everyone were to sell, it would drop the price down to zero. It's perceived value. And if you want to know that you have a certain amount of wealth in this case, you got to have it in something that retains whatever metric you're using. If you want it to be in crypto in the long term, I understand that. I understand the value proposition about how central banks could fail in the long term. But that's, again, why I just want to emphasize here that the further your risk is when it comes to leverage or being overexposed to altcoins versus Bitcoin, and also just being overexposed to crypto in general, can wreck your net worth over the next few years. The good times, guys, I got to be honest, if that chart from the Dow Jones doesn't scream it for you, that the good times are likely over for a little while, and that it can get much worse here, that it can decline severely over the next few years, or have something that we can't even imagine, it's going to be very, very painful. So, all I wanted to do with this video today, guys, is just try to accentuate those points here and get you thinking about the worst case scenario. Can you be prepared here? And that's why, again, I recommend, as much as we want to buy the dip, we want to ride the next bull market, some of the best traders don't try to catch falling knives. They don't try to predict a bottom. They don't want to be a Nostradamus. No one really can be. There will be one guy out there who likely buys the absolute bottom of the market. But in reality, the best thing to do is to wait for the trend to set up for you. Let the bigger institutions take that risk of trying to pick the bottom and essentially wait for the wave to start to formulate. Let price tell you that it's time to ride the waves, to get on your surfboard and basically ride the wave of the market. Right now, there are a lot of people exiting the market rather than entering, and that is declining the values. You can see in the center point at the top part of the screen there, over 21% down here for the Dow Jones alone. NASDAQ, S&P 500 getting hit much worse. Crypto as well, down around 70, probably 80% across the board here. We've got a lot more pain to come here, folks, and we got to be prepared for it. Now, if you guys like this kind of rambling here on the channel, I highly recommend you guys check out the Dash Report. This is our newsletter here on the channel. If you've made it this far, I feel like it might be valuable to you guys. It's basically a newsletter where I cover crypto, equities, Forex, commodities. I give a whole macro perspective on what I'm seeing in the market, what I'm bullish on, what I'm bearish on. You guys get my trade alerts. You guys get exclusive market updates that sometimes build on top of these daily or macro Monday videos here on the channel. You guys will also get the discussion group where you can chat with people. You can see my percentage exposure, my portfolio, all kinds of really cool tools that can help you guys out in your investing journey. But until the next video, everyone, thank you all so much for watching. If you want to check out the Dash Report, it's down below in the description. You can get 20% off on your next subscription. But until the next video, everyone, I'll see you all in the next one. Take care, everyone.